guys. Welcome to the HGR Digital Asset Group podcast series, where we interview thought leaders in the cryptocurrency and blockchain space. Today, we're super excited to have Jack Tatar, an angel investor and advisor to startups in the crypto asset space and co-author of a book that everyone should definitely read called Cryptoassets, the Innovative Investor's Guide to Bitcoin and Beyond. So, hey, Jack, how are you doing today?
I'm doing great. I'm very excited. I'm looking forward to this podcast. I know you've got a great team there behind this, so hopefully I can keep people entertained and listening in. So very excited. Thanks for having me.
No, totally, for sure, Jack. And I think, just to emphasize the book you wrote, I think is kind of the seminal the book on the space on sort of valuation framework and how to think about investing in the space like intelligently. But Jack, so I guess just to kind of start off here, can you just kind of walk through your personal and professional background and talk us through kind of how you found the light and found crypto?
Sure, no problem. So I've actually been involved in Bitcoin and crypto since 2013, and I'm a bit older. I'm a bit older than my co-author. I've actually been worked on Wall Street for about 20 years, and back in 2013, I was as part of my market research firm. I was doing some work evaluating new technologies for the financial services, and Bitcoin came along, and we took a look at it. And basically, I fell down the rabbit hole there and wrote a book with actually an associate from my company, Ryan Lancelot, which was one of the first books ever written on Bitcoin, which was called "What's the Deal with Bitcoins." Um, and and then after that, I was also at the time I was writing for MarketWatch.com, and I was actually writing a retirement column because I'd written a couple of books about retirement. And I started to speculate and started to evaluate Bitcoin as an investment and speculate that it could be placed into a portfolio, essentially as its own asset class and accordingly as a alternative asset. So I went through a series of articles. I actually made an investment of my own funds into, at the time, Bitcoin Investment Trust, which is now GBTC, which was about the only, which was the only thing you could invest in at the time and get it into your retirement account. You could obviously invest in Bitcoin and things like that, but so I invested in that. Probably 6 months after I made the investment dropped 50%, and I remember writing an article about that, and I think MarketWatch said they had never gotten so many negative comments. I was called every name in the book, a moron, an idiot, whatever.
Mm.
Of course, 6 months after that, it was the best investment that I had made, and to this date, um, the $25,000 investment that was made in that fund back in 2014 is now worth over $1 million. So, but I positioned it at the time as an alternative asset. So I've been taking a look at Bitcoin and the space from the perspective of investment options, and I came across Chris Burniske, who, as many of you know, is really a leading analyst. He's really taken this valuation approach, and he and I wrote the book Crypto Assets, really to put a stake in the ground, not only about the taxonomy of what we feel crypto assets are, but to also kind of create a foundation for other people to work with in terms of valuation, evaluation as an investment, clarifying why we believe it's a new asset class. So I appreciate all the kind words that you've said about the book. Additionally, I'm also an investor of my own, so I am an angel investor to a number of startups. I've worked with startups in the space, in the crypto asset space, and in the blockchain space. And that company is Doyle Capital Management. One of the investments we made, which some people might remember, is a company called Lawnmower. I don't know if you guys remember Lawnmower. Lawnmower was actually one of the first um, mobile apps that allowed you to invest small amounts into Bitcoin. They were bought by CoinDesk. Um, Learned a lot of things from those developers and from the space, and now so I continue to do investing in the space and looking out for early stage companies. We invest in early stage companies. We work with them as advisors, and really super excited about what's going to be coming along in the next few years from a lot of these companies and the innovation that's going on in this space overall.
Totally no, Jack. I think that's super interesting stuff, and I think you come from a great background, and um, I'm totally appreciate you kind of going through that. So I guess to go back to the book, right? And I keep talking about the book a lot because I'm a huge fan of the book. But maybe just talk to us about the high level process and how you and Chris thought about writing the book. You're coming into this frontier market where no one's thought about valuation from before, and so you're kind of coming in with sort of tabula rasa, right? And so, what are some of the challenges of that? Looking at the space and sort of trying to set the first precedent of what valuation should look like.
Well, I'll share with you a little bit of the backstory of the book, which I don't know if I've
Yeah,
discussed
totally.
in the past, but it's rather interesting. Chris and I Chris and I came to the conclusion, and Chris and I actually met during a lunch at a consensus conference a number of years ago. We actually sat next to each other at lunch at the consensus, and we started talking to each other, and we really decided that there needed to be a book that viewed Bitcoin as an investment. And Chris had done a lot of work as an analyst with ARK Invest. I had been looking at this as an investment vehicle. And I don't know if anyone's gone through the process of writing a book. It's not a fun process, but basically you've got to pitch the book to a publisher. And at the time, there weren't a lot of books out there about this topic. So we actually then got some interest in the book. We signed with McGraw Hill on the book, and the original title of the book, which is interesting, it was going to be called Blockchain Assets, and it was right. It was a little bit after Blockchain Revolution had come out, so that was what the working title was. As Chris and I started to explore the topic, we started to realize that we were not happy with the way the taxonomy and the referencing of this space was being done. There was a lot of talk about blockchain, a lot of talk about, well, I like blockchain, but I don't like Bitcoin, and everyone kept referring to these assets as cryptocurrencies, and we really wanted to put a stake in the ground. So we called it crypto assets, which may not be the easiest title that rolls off your tongue there, but we wanted to do that because we wanted to set a taxonomy that we believed separated out these assets. And I think going back to your question about valuation and some of the challenges there, when you take a look at these assets, they're not all cryptocurrencies. And consistently, we see in the press the reference to cryptocurrencies. And what Chris and I found is that you can divide these up into different segments. A cryptocurrency is a fine reference point for something like Bitcoin and Litecoin, and probably Bitcoin Cash. But in Ethereum is different. Ethereum we call a crypto commodity. It's more of an infrastructure, more of a platform. And then you have all these dApps that are out there, the Aragons, the Orgas, all of these other applications that are being built using this technology. And those we refer to as crypto tokens. Now, part of this was to get the taxonomy right so that you don't call them all cryptocurrencies. But the other aspect of this is that they're all different. So when you talk about valuation, we struggled in the book with trying to come up with valuation for Bitcoin, which I think we put at least a foundational basis there. But then when you take a look at this, can you really compare a valuation between Bitcoin, which is a currency, cryptocurrency, and Ethereum, which is a crypto commodity? They have different properties, and they should be evaluated differently. So that comes into play when you're evaluating and you're trying to put a valuation methodology to these assets. And so that is a challenge that we've had, and it's something we still struggle with to this point. But I do believe that probably in the next 3 years, 3 to 5 years, we're going to start to see this space segment up even more. You're going to start to see dApps that are based on smart contracts, maybe cryptocurrencies that are privacy coins, and further segmentation within the crypto asset space. And they'll have to be valued differently, almost as you value stocks, retail stocks, and energy stocks, and those types of things. So I think you're going to see that, and I think we're going to start to see analysts and very smart people start to play with data, because the other challenge we have, there's not a lot of data out there. we have data on Bitcoin because Bitcoin has been out there for a while, and we're getting more data on Ethereum. But how much data do we really have on a lot of these crypto tokens? And the more data you get, the more hypothesis you can put together to evaluate and value these assets. So that's another thing we struggle with as well is the data. But like I said, what we wanted to do is put a foundation down there that people could build upon. We know that what we wrote uh, will probably be built upon. It may not stand the test of time, but we hope that it'll be a foundation for people to develop on and evaluate these assets going forward.
Yeah, no, I agree with you there, Jack. And I think the two things you mentioned that kind of stood out to me is a sort of the taxonomy, sort of market mapping of this broad and evolving asset class, and kind of secondly, the scarcity of data, right? Besides Bitcoin, which even arguably is still is hard to sort of use the block explorer and stuff like that to analyze its inner workings. So I think those two things have to get built out, or people have to kind of rally around thinking about it and get comfortable before you see more adoption, right? As more people get comfortable as to how to value these assets, I think you'll see more sophisticated and, frankly, bigger dollars come into the space.
Right. And a big part of that is
yeah.
a big part of that is that people evaluate these properly. I mean, I can't tell you how much it drives
Yeah.
me nuts when I see everything referred to as a cryptocurrency, when in essence they all have different properties. So it's education, it's knowledge. You know, we're in the early years here. We're growing, and hopefully we can set some direction for people to move forward in this space.
Yeah. Yeah. No, agree 100% there. So Jack, I think so you run, I think, correct me if I'm wrong, but you're also an investor now, right? At Doyle Capital. Looks like you guys were started up fairly recently in 2017, and so would just kind of love to hear about that, right? Like, what's kind of your investment mandate and strategy, and kind of any other services you offer? Like, what do you guys do at Doyle Capital?
Well, we've actually been investing for a period of time in this space, as I mentioned about lawnmower
Oh,
uh,
okay,
and some
right.
other companies. But no, but that's fine. That was more on a private standpoint. Now we are an investment firm, and we are doing hedge fund investing, and basically our focus is uh, really focused on early stage companies. We are really looking at what I refer to the new emerging growth uh, companies that are out there, and I just think what we've seen is that the innovation and the innovative developers and the innovative business people have gravitated towards the blockchain and crypto space. Um, we're not seeing. I mean, it's absolutely amazing the projects that we're seeing on a regular basis. It's also amazing how much garbage we see from ICOs that get put in front of us. But that being said, you know, we've learned over the years that we've been doing this how to kind of separate the two. And I think what's very interesting now is the real innovation is coming in this space. I don't want to say it's not coming from Silicon Valley because there are people who are developing in Silicon Valley, but the whole paradigm has changed. It's no longer the thinking that okay, I've got to put something together. I've got to work with this venture capitalist. I've got to do an IPO. I've got to go public, blah, blah, blah. All those things that were very important during the dot com era. And I think now we're starting to see that the whole capital raise um, uh, business is different. Obviously, we've seen people who have done ICOs and they said, "Well, I'm raising money. Here, give me money for my ICO, and then I'll go develop this." So that's been something that's been interesting in terms of turning the whole capital raise market on its head. It's also something that's been not really appropriate for investors, which is why we're starting to see the SEC step in. But my point being that this is really where the innovation is happening. So right now we're working with early stage companies that are getting involved in the space, and a lot of times they could be involved in blockchain technology. They could be involved in technology like the Internet of Things. They could be involved in technologies like distributing computing and those types of things. Sometimes there's a coin element to it. Sometimes there's not. But there's this thinking that we're seeing that's very different from the thinking we saw during the dot-com era, around viewing blockchain technology, the potential for incorporating cryptos where appropriate, but specifically looking at things on a more distributed basis, and viewing the funding and the capital raise much differently. So we try to involve ourselves with these companies. We step in as advisors to these companies, and like I said, some of them do a coin offering, some of them do equity raises. But we work with these companies to ultimately um, turn them into the companies of the future. And I think what we're going to see 5 to 10 years from now is you're going to see a wealth of companies that are going to come from this space that are going to be the next Amazons, the next Googles, the next Facebooks out there. They're going to come out of this group of companies, this innovation that's grown out of this blockchain and crypto space. And that's what we're hoping to capture. We're hoping to capture some of those early stage companies who are being involved in the space, and that's basically what we look for. We have a proprietary system to try and identify them. Like I say, we work closely with these companies, and then we invest with them, and for the long run. And That's pretty much the thesis that we've been following for the last few years, and that we'll be following going forward in our hedge funds going forward through Doyle Capital.
Got it. Thanks a lot for going through that, Jack. And I think obviously you see a lot of early stage opportunities, and kind of especially in crypto in particular, right? Like it's very hard to separate the noise, filter out the noise, and dig down to kind of what's even like reliable information out there, and what's like a quality asset versus the majority of the assets in the space, which are probably less kind of investment quality or institutional investment quality at least. So I know you mentioned proprietary system, and I'm not trying to get you to share
Oh,
your secret sauce with us, but at a high level, it's just kind of how do you what sort of like criteria do you sort of runs through your mind when you see like a new opportunity and you decide whether or not it's interesting.
sure. No, I appreciate that. And obviously, we have a system that we employ, but I'll go back to some of the analysis that we did in the book, which I think a lot of it still holds up. In the book, we talked about the whole ICO craze that at the time that we were writing the book was really just starting, and it was pretty amazing to see how the ICO, the wild west of the ICOs, just blew up even after we wrote the book and over the last year or so. But we put into place in the book a way to evaluate ICOs, and I think that they still hold up. Before I go into that, I'll share with you just briefly. As I mentioned, we look at hundreds of ICOs on a monthly basis. We're constantly looking at these, and we're constantly meeting with new companies. And it is absolutely amazing how many companies will come to us and we'll ask them for their elevator pitch, and they say, we're doing a coin offering. We're doing a coin offering. And typically we'll say, well, why are you doing a coin offering? And they'll say, well, that's where the money is. That's where the capital raise is, and that's where we can get money right now. And and I don't want to say we dismiss them right off the bat, but we're pretty close to dismissing them at that point. We only want to take a look at companies, and I think this is very important for not only an investor like myself, but the individual investor who is looking at ICOs. If the company has a valid business and it can stand on its own and it can raise equity instead of just raising a coin because it has a valid business approach, then it could be a good investment. The other thing is it has to have a coin that's integral to the utility of that application. If the coin feels like it's just attached there as a way to raise money, as a way to bring cash in to fund the company, it's probably not a good investment. The technology out there right now between blockchain and crypto is such that if you're going to integrate a coin into the business, it should work in the utility of the business. And if it doesn't feel like it doesn't belong there, then it shouldn't belong there. It shouldn't be placed there just as an element of raising money. So I'll go back to a little bit about the ICO analysis that we put in the book. Obviously, when you're looking at ICOs, one of the first things you see is, somebody comes up with a white paper. And obviously the white paper is the starting point. What I like to say to people is, the white paper has to be detailed, thorough. There has to be no spelling mistakes in it. But I think what's key is after you read it, could you explain it to a friend? I mean, if a friend of yours says, "Well, what is this company all about?" You've read the white paper, and if you say, "I have no idea," or "There's a lot of buzzwords in there and I don't understand it," it's probably not something for you to take a look at. Additionally, to come back to that point that I made about having a coin being an integral utility aspect of the business, um, it has to have the decentralization, what we call a decentralization edge to it. Vitalik had a quote which we used in the book, which I think is very valid when you're looking at an ICO in this space. He said projects should really make sure that they have good answers for why use a blockchain. Goes back to my point about I'm doing an ICO just to raise money. You've got to really have a point for why you're using a blockchain. Then you have to take a look at valuation in terms of really what is the utility of this business going to provide in the short term and the long term. There's aspects of velocity, discounting, all of those types of things, which we don't have time to go into today. The other thing that's very important for us there's obviously in addition to the competition, you've got to take a look at what the competition is out there. But two aspects that I think are very important is the issuance model. What is the issuance model of that ICO? How are they creating the coins? How are they releasing the coins? How are they distributing the coins? Who's getting the coin? Because you've got to remember, you want to make sure that the development team and all those people who are critical to making sure that that business is going to thrive stick around. So you want to take a look at the way coins are issued, the distribution of that, and then the last piece of this, which is probably the most important for us, and from what we've learned, our contacts and also the way we evaluate the community, is taking a look at the team that's involved in an ICO. You can take a look and see who the developers are. You can take a look and see who the advisors are. But additionally, you want to take a look and see how that ICO, that new company, is going to be relating to and involving itself in the community. Slack channels, Reddit channels, Twitter channels. Very important for companies in the space to really engage their community. So there are ways that you can measure this. I don't know if many of you are familiar with sites like Charlie Hayter's great site, cryptocompare.com, but you can actually go out there and you can see how many lines of code are being written on a project, how many social media followers they have, how much social media activity they have. Now, obviously, this may not be something for an initial stage, but even when the coin is out, there are ways to still follow this and track these types of businesses. So these are all aspects that I think are very, very important that you want to take a look at with an ICO and even with existing coins. Because right now, there are a lot of projects that came out. And like you say, there are a lot of bad projects, but there are some real good projects that are out there that may have been unnoticed or people just neglected. And you can go back there and you can still take an analysis that we go through, and you can find some coins that are out there right now that are doing some wonderful things and will probably last the test of time. And they could be a real bargain in this market. So those are all aspects that we take a look at around both ICOs and even existing coins and existing businesses that are out there.
No, I appreciate the color there, Jack. And I think it's interesting, right? Like you mentioned, sort of, really the first litmus test is it's kind of does this thing deserve to be on the blockchain or not? If it's just a digitized security, that's a little sketchier, and that's maybe sort of a red, yellow light type situation. I think you want to invest in projects that just lend themselves naturally to sort of the strengths of a distributed ledger technology, right? Whether it be decentralization, as you mentioned, or some sort of judgment resistance, trustlessness, or immutability. So, Jack, I think there's just kind of like thinking through the numbers. There's been over $4 billion in ICO funding across like 1,200 plus crypto assets to date. There's no doubt that a lot of this is driven by hype, right? Because if you take like the 30 minutes to diligence these assets, I'm pretty sure 80 or 90% of them or more don't deserve to be on the blockchain. You're better off using an Amazon AWS solution, Oracle database, or some other incumbent centralized solution. So, given that you've tracked the space for a while, you've seen a lot of these ICO deals. Are there any broad kind of themes or use cases or sectors that you are most enthusiastic about with regards to there being a true value added blockchain use case in call it the near to midterm?
Well, I think there are now, I'll share with you a little bit about spaces that we find
Yeah,
to be of interest at this point. The one thing I do want to just before I go into that, the one thing I do want to just mention is for investors like ourselves who are looking at these companies and working with these companies, and I think this is a little bit of a trend that's out there in the venture space is we're actually seeing some companies that are coming through with very, very valid business models, and they're thinking, okay, we're going to do an ICO. They'll run into a firm like ours or other venture capitalists who will say, well, maybe you're not ready for the ICO now. And if it's a valid business model, potentially you'll see that ICO get pushed to the side and say, let's fund this project first and then let's talk about an ICO. It's somewhat familiar with like the Filecoin offering that we saw. Even though Filecoin raised money initially, they went back and built the project, and we're all waiting for Filecoin to come out. I think what we're seeing with some of the venture capitalist people who are basically saying, "We'll give you the money you need to build this. Hold off the ICO, and come and do the ICO, or potentially don't even do the ICO. Just do an equity raise." And some other method of getting the coins out there, but do those things when the project is up and running and in better shape than it is. And I think those are going to be things that are going to identify good projects down the road. They're also going to help to, I don't know if skirt is the right answer, but help to address some of these concerns that the SEC has as well. So that's just a trend that I'm seeing right now. And that's another reason why I think in 3 to 5 years, you're going to start to see a large amount of really high quality companies come out who did not do an ICO raise, but they have great tools, and a lot of that is because of the involvement with venture capitalists and early stage investors. Back to your question about what we're looking at, I think what's really exciting at this point is a lot of the infrastructure and distributing computing projects that are out there. We're seeing projects. I mentioned Filecoin before. Filecoin, which is really something that could ultimately turn the way we use storage and the cloud. It could really flip it on its head, where you now distribute the storage capabilities of files to any individual. You could leave your computer running, and your hard drive can earn some tokens for allowing people to use it as the storage cloud. And additionally, distributing computing power. I know that there are some technologies out there right now that are just mind blowing in terms of how they're going to basically harness the power of an individual's computer to produce cloud computing technologies. You're going to have businesses that at night when all their workers are gone, those computers will be left online, and that will be a massive amount of computer power that will be accessible to people to utilize in a cloud computing fashion. This is going to be an amazing thing because it's distributing the computing power, creating an infrastructure that's going to allow new revenue sources for individuals, new revenue sources for companies, and really change the whole paradigm of how we view computing. So there's things along those lines that interest me. There's projects that are around governance. The other thing that's very interesting to me, which is a little bit outside of just investments that we're taking a look at, but is the whole space of um, government and how potentially we could have a situation in 10, 15 years from now where people are actually competing for government services. Right now in Estonia, they have this. this e-residency program. So you can become an e-resident of Estonia, and you can actually buy community services, community resources, and government resources from Estonia, such as maybe title insurance or record keeping or whatever. So can you imagine a world where we had the governments competing against each other for different government services? You might get your health care services from Denmark because they do it the most efficient way. You could be getting your title insurance from Sweden because they do it the most efficient manner. This is something that could turn the whole way that we do uh, government projects and governments and nations upside down, and it's all because of the distributed nature of the technology. So that's something that's very exciting as well. So there's a lot of great things that are going on out there, and it's just exciting. Every week there's different projects, but you really look for not so much those things that are going to disrupt technology. I know people like to use the word disruption, but I see it more as an extension and the progress of where we need to go. And just because of the distributed nature of the blockchain, we can get to these places that many of us never thought we'd be seeing in our lifetime. So it's very exciting stuff.
Yeah. Yeah. No, there's a lot of interesting things you said there. Distributed computing. It's not just like distributed computing, right? It's like sort of distributed computing of computers that are like sort of underutilized. Like you already have this big fixed cost anyway, and you're just kind of uh, partitioning the excess capacity in some respects, right? So increasing efficiency on an already existing capital base. That's pretty cool. Um, I guess, Jack, like moving on to some maybe a more macro-ish question. I guess realistically, there's a lot of talk about institutional capital coming in. So in your opinion, when do you think all of this like alleged sidelined institutional capital will start entering the crypto markets? Like we're definitely seeing a path where with the rollout of custodial solutions like BitGo and Kingdom Trust, Coinbase Custody this year, Ledger probably does something with their new 75 million Series B, and the arrival of these institutional quality vehicles. I think you mentioned GBTC earlier, some of the CME CBOE derivatives, and paired with sort of the increasing regulatory clarity we're getting too, right? Do all these things align for institutional capital, or at least a big wave of institutional capital wave in sort of the next like 12 months, maybe 18 months, or do we need to see more development in other aspects of this asset class before investment becomes more palatable to some of these bigger players?
No, I think we're seeing that. I think we're seeing that right now. I think we're seeing institutional money coming into the space. We're seeing Um, obviously, first of all, we're seeing investments for, accredited investors and high net worth investors, probably initially coming in because of the risks that are associated with it. But even that kind of money is coming in is coming into companies, but in terms of a large amount of it, I think that there's still a need to address two major issues. One is the custodial aspects of this. I mean, you know yourself, investing in crypto is not easy. Okay, the variety of exchanges, the custody aspects of it, those come into play no matter how much money you have. Okay, if you have a lot of money, you just have a lot more of a problem. There needs to be more custody solutions out there. I mean, we're starting to see Coinbase become a little more aggressive and a little more active in that, but I think we have to get to the point where the whole ability to invest in this space, even for hedge funds and even for venture capitalists, has to be easier. So we've got to address the custody aspects of it, and the other aspect is regulation. Now I know, and I'm the first one to point out that this is a global phenomenon, and it doesn't really depend upon what the United States says. However, that being said, we really need to see some leadership and some guidelines and some regulation, or at least some opinions put into place by the SEC and government regulatory agencies here in the U.S. I don't think it's a bad thing. I know that there may be arguments about we don't need these people involved in it. I think we do. I think it legitimizes the space. It also opens up the ability for the regular investor to get involved in this. And it's not only about involving the regular investor. Once it's opened up on a large scale, the education becomes more widespread. Right now, you have a situation where financial service companies will not even let their advisors discuss this space or Bitcoin with their investors. So not only are they missing the investment opportunities that exist here, but they're dismissing something that down the road they're going to have to play catch up on, or people are going to jump into it without a lot of education. So I really hope that this becomes more legitimized, more widespread, and people become better educated on this space and involved in the space. And I think that's where regulation can come in. We're already seeing for the individual investor, like I said, it's not easy to invest in crypto. So you're going to see more people once we have ETFs, once we have mutual funds that will go to the individual investor, and the financial service firms will finally figure out how they can make money off this space, and they start discussing this with their clients. You're going to start to see this permeate more and more portfolios and get involved in more people's portfolios because the ease of investing in an ETF is a lot different than going out and buying Coinbase and buying a ledger and all. You don't have to worry about those custodian issues when you have an ETF. And I will tell you that's the government regulatory agency's biggest concern is the custody aspects of it. I'm working with a firm up in Canada, and I presented to the OSC, which is the Toronto version of the SEC, and their concern really is around custodian of these assets because there's still this fear about hacking and losing these assets. So once again, it comes back to the custodial aspect of housing these assets. I do believe those things will be addressed, and I do think that probably, as you mentioned, in the next 12 to 18 months, we're going to see products that are going to come out to the individual investors, ETFs, mutual funds that are going to make it easy for people to invest in this space, more education in the space, then you'll start to see people do better valuation methods, uh, valuation models, and then it will become something where people can invest in the space with much more education than they have right now. So I think that is right around the corner. But like I said, we've got to see the government agencies step up and at least provide some opinions in some direction.
Yeah, I mean, as always, Jack, I agree with you kind of on the fact that regulation is a good thing. It legitimizes the asset class, and if you read, I think, in my opinion, I saw Giancarlo's sort of CFTC testimony. I thought that was bullish, and so and I agree too on the other point, which is the rise of kind of these ETFs and passive investment solutions for the average Joe, right? I think right now you have something like the Bitwise Hold 10 that's only open for accredited investors, but increasingly you'll probably see that trickle down to the average Joe. I think hopefully in the near term here. I guess somewhat related to that question is to that line of thought rather is you mentioned that crypto assets could be effectively incorporated into anyone's portfolio, right? It's a lot of people think about it often in sort of this binary light, like, oh, it's too risky, I don't want to invest, it's too volatile, versus, oh, I want to invest in it because it's sort of this high growth asset class, right? And I think it's more a question of like sizing rather than like a binary yes or no decision. And so I guess what percent or like how would you think about how would you recommend like an average Joe think about allocation towards crypto assets in their individual portfolios?
Well, I come from years of actually being a financial advisor and sitting across the table from individuals and talking to them about their financial future. And at first, I want to basically say I'm not an advisor anymore, and every client is different. That being said, I do believe that when you look at portfolio allocations and portfolio modeling, and whether you're a young millennial investor just getting started or if you're somebody in retirement, you should have an investment portfolio that is properly allocated among different asset classes and different sectors. It's my belief, as we've said in the book and as I've done a lot of research on, that I think you can view certainly Bitcoin and probably the whole crypto asset space as an alternative asset. And what I mean by that is you have your stocks and your bonds, and typically they make up the majority of your portfolio because if stocks go up, the thinking is, well, bonds go down and vice versa. And you want more growth, you put it in more equities, you want a little more conservative, maybe less returns, you put it into bonds. But what we had in 2008 was a situation where both stocks and bonds went down. So there was a real interest in having this third portion, this third sleeve, which was referred to as alternative assets, which really has no correlation to stocks and bonds. They're uncorrelated assets. They're typically viewed as things like gold, real estate, maybe natural resources, and things like that. And obviously, you can buy, gold ETFs and those types of things, and they may fill the sleeve for people in alternative assets. It's my belief, and in the evaluation we've done about the non-correlated nature of Bitcoin and crypto assets, that they basically stand up as alternative assets. So when you take a look at your portfolio, and like I said, everybody's different, but even investment firms, all those investment firms who I said we're not talking about Bitcoin, they have asset allocation models that consist maybe of like 50% stocks, 40% bonds, and 10% alternative assets. I mean, if you have an advisor, ask him what his allocation is, and he'll say that he has an aspect of alternative assets that you should be in. I think that crypto assets and these ETFs and any other investments that you want to make in crypto assets can fit into that alternative asset space. So for the typical investor, that can be anywhere from 5 to 20% based upon who they are. Closer to retirement, probably smaller. Away from retirement, you can take a little bit more risk. It's all that risk reward, which we talk about in the book. But it should not be all of your money. I mean, I've heard people say that don't invest more than you can lose in this. And granted, this is a risky asset, but the reward is there. That's why the Sharpe ratio is so high on Bitcoin. You're being paid, you're being rewarded for the risk that you're taking in Bitcoin and crypto assets over time. But they shouldn't be that large portion of your portfolio. The problem becomes, as we saw, and it's a good problem to have. It's maybe not a problem we've had recently, but 6 months ago, that 10% of your portfolio might have grown to 30 or 40% because of the big returns you had. Then at that point, you've got to come back and you've got to reallocate and rebalance your portfolio. And see, this is where my concern is that the financial service companies are not allowing their advisors to bring this up because people may do a small investment and then all of a sudden it grows to 40% of their portfolio. But because they don't have the assistance of an advisor to help them and guide them to the portfolio allocation, they stay overexposed. And all of a sudden, potentially we get a drop down and we lose those assets rather than selling those assets and moving them to another asset class. So there's always rebalancing that needs to go on there. But just come back to your question here. Everyone is different, but I think you can view this as an alternative asset and accordingly, based upon your asset allocation model, probably fits somewhere between 5 to 15, 20% of your overall portfolio.
Yeah, that makes sense, Jack. And I think the other thing people don't really appreciate is like it's a volatile asset. So it's got a Sharpe ratio. The other thing is it's a idiosyncratic, like non-correlated asset, right? Kind of people, the, crypto plays in sort of a different capital pool right now as compared to like equities and bonds. And so I think if you run the regressions, the correlation is actually fairly low. So you might have like more volatility on a nominal basis, but it's because it's non-correlated to your equity portfolio, your bond portfolio. You're actually kind of increasing the overall Sharpe ratio of your portfolio if you
Right.
take a little bit
Right.
of exposure.
Right, and it goes back to
Yeah.
the Harry Markowitz modern portfolio theory aspect of allocating these assets and having a non-correlated asset, and yeah, all those points.
So I think that's everything we have. And then again, thanks so much for honoring us with your presence. Very insightful comments, Jack. As I've learned a lot, and I'm sure people who are listening will learn a lot too.
Sure. Thank you very much. Thanks everyone for listening.